I've been very positively surprised by the strength of the U.S. economy in the face of fairly consistent interest rate raises. And I think the interest rate raises are the right policy if you believe in policy at all. It would appear that although inflation is softening, inflation is still problematic. The government's own numbers suggest that the U.S. dollar continues to deteriorate at 7% compounded. So from their point of view, I think they need to raise interest rates again. I think they can raise interest rates again, and so I think they will raise interest rates again. My gut tells me what the consensus is, which is to say 25 basis points. I would caution your listeners that the economic response to public policy often lags, which is to say it may be that we have not yet felt the hard punch of the interest rate rises. You will note, as an example, that higher mortgage costs have slowed down sales of existing homes and really slowed down new home construction, but the prices haven't fallen yet. My memory of prior interest rate rises is that it often takes a while. There's often a lag for the effect of policy to be felt on the economy. So time will tell through the balance of 2023 what the Fed will do and should do with the impact of this interest rate rise on the broad economy. Certain problems around the world have already been felt. I draw your attention 7 or 8 weeks ago to the real perturbations that you saw in the gilt market in London, where the rising interest rate lowered the capitalized value of long-term bonds at the same time that the hedge funds that were playing the long bond, funding it with overnight funds, ran out of money. We aren't out of the woods yet, but I have to say, Daniela, the U.S. economy has really surprised me with its strength in the face of interest rate rises. So perhaps the big thinkers can organize a soft landing. I personally don't believe that, because in 50 years, I would be very cautious about speculating in real estate, particularly over-leveraged. The fact is that in the course of my lifetime, the expected down payment on a house has fallen by 2/3, which is to say that the reliance on leverage has increased an awful lot. I am nervous, too, about the proliferation of adjustable rate mortgages that were sold 3 or 4 years ago when capital was cheap. I think a crash might be too strong a word, but I suspect that the market clearing price of real estate right now is probably 15 or 20% below the ask. If you don't have to buy or sell, that doesn't feel like a crash. But if you do have to sell, 20% below what you're expecting to sell for might indeed be a crash. Understand that the 30-year fixed mortgage rate, which is, from my point of view, the prudent borrowing product for homeowners, has increased in terms of interest expense by half. Or let's put it differently, it's doubled in the 2-year time frame, which substantially reduces affordability, particularly for first-time home buyers. Where you're seeing a crash now, I think, is in new home construction, in starts. But I suspect as the interest rate continues to go up, that the price of single-family residential real estate will decline. What's happened right now is that the bids have fallen, the asks have stayed the same, and so there's no volume whatsoever. The gap between the bid and the ask has broadened. And in my experience, in the face of higher interest rates, that gap gets closed to the downside. I know that a substantial number of people are able to buy real estate for cash. And to the extent that affordability becomes less of an issue, remember that housing is also a home or shelter. And to the extent that you see something that's going to suit your purpose for 20 or 30 years, perhaps you worry about near-term perturbations in price. I was talking about the first-time homeowner who maybe will or maybe won't be able to afford their home, or the legions of speculators who enjoyed a 40-year period of continually declining interest rates and enjoyed the boom of baby boomer demographics coming into housing. I think those two parties are over, at least for a while. And I think that the marginal buyer of housing will certainly be impacted by higher interest rates. For your audience, an upper income, an upper net worth audience,
Right.
more sophisticated audience, they get to look at real estate differently than other people. I believe that some forms of inflation are going to abate. I believe that stable real estate prices may lower rents in some markets. I believe that energy costs will begin to moderate in the near term simply because they went so high. Markets work. It has nothing to do with Biden's brilliance jawboning the oil companies. It has to do with the fact that supply and demand are adjusting price. So I think that energy prices will begin to moderate. But I would note, as an example, that real inflation isn't necessarily measured by the CPI. Many of your listeners, Daniela, won't remember that taxation, which is to say the cost of government, isn't included in the CPI. And the cost of government will continue to go up. Now, I guess I wouldn't complain so much about the index if I didn't have to pay the tax. But I, along with the rest of your listeners, will find that their total cost of living, when you include as an example increased taxation, and stubbornly high prices for goods and services, may find inflation to continue to go up. The second thing, Daniela, that I would note, and please remember I'm no economist, is that we've had very modest wage and salary increases in the last 3 years, which is to say that most workers have experienced a deterioration in their ability to afford their lifestyle. And I would suspect that you're going to see real wage pressure in 2023, 2024. The jobs market in many categories is still very tight. And the truth is that workers in those occupations have not seen wage increases that kept pace with inflation. And I think that you're going to see, very much like you saw in 1976 and 1977, very consistent and very powerful demands for increased compensation in the labor force, which will ultimately find its way into pricing. I've used this example before for your listeners, but I assume you have lots of new ones. When I was a young man, I used to stay at a place called Motel 6. It was called Motel 6 because you could get a room there for $6 a night. And as a youngster, that was right on budget for me. Not too long ago, I passed a Motel 6 in northern Washington, said Motel 6, $119 a night. Now, there's only two explanations for that, Daniela. It could be that a room at Motel 6 is now 15 times the size with much better appointments. I don't suspect that that's the cause. I haven't done recent due diligence on Motel 6, but I suspect that the fact that Motel 6 is now $119 reflects the deterioration in the purchasing price of the U.S. dollar. And I think that you need to consider evidence of inflation over time. Think about, if you're old enough, how much money you got paid in 1980. Think about what a house cost in 1980. Think about what a gallon of gas cost in 1980, and understand that the ravages of inflation are cumulative and compounding.